We're going to turn it over to Joe Kerns, coming to us live on the road from an airport. So, Joe, take it away.
Guys, thanks for having me here today and for the opportunity to address you. Next slide here, please, Nate, is similar to what Bill was sharing earlier, is what I'm going to offer you today is my opinion. I'm going to do the best I can to kind of analyze a few things, but the outcome of your decision-making metrics are on your own, and I'm here as an opinion. Next slide, please. We're going to be talking through a few things here today, and this is kind of my agenda. We're going to talk about the grain trade. The grain trade has really come to life here recently, and we're going to talk about where it sits and what to do. And that's that last bullet point, is most importantly that if you take anything away from this presentation, it's what do I do about this? We're going to try to handicap the tenets of what's going on, but then also try to provide some actionable items here. And kind of one of the items that I really want to address is what I call the clanging gong versus the whispers. And in this market, it's important to pay attention to the whispers, because there are a lot of clanging gongs that are occurring both in the grain side as well as what's going on the livestock side here. Next slide, please. So when we kind of start to jump into this, go ahead, and that's what I was referencing the whispers. Go ahead, Nate, give me one more there. Is when we take a look at the crop situation, and the total crop scenario is really the key driver of where we're going with the grains. So we're going to focus a little bit right now, or I think it's human nature to talk about where are we, but most importantly, it's where are we going. In that bottom right-hand corner there, you're going to see that we're going to increase someplace in the neighborhood, of my best guess, of 8 million acres. And go ahead and click me there, please, Nate. And where those acres lie out is very important. And what this line depicts is the orange line is not break even as far as profitability, but it's more about break even of when the corn economics are on par with soybean economics. And as that blue line increases, soybeans have begun the rally. They started it much, much sooner, and they are begging for the acres. And I think for good reason. Right now that Iowa State University would tell you that corn on top of beans is more profitable than beans after a corn on corn type of rotation right now. But depending on your soil production and the types of agronomic conditions that you're working with right now, we are going to be in an acreage battle. Next slide. My best guess is going to look something like this, and I need to move over so I can see, is that we're going to add someplace in that bottom right-hand corner of nearly 8 million acres. But take a look, if you just assume that current economics are reflective of past behavior of how that all occurs, is that 7 million acres or so are going to go into soybeans, and you're going to lose some acres in the corn scenario here. And that's going to be kind of one of the main tenets as we roll forward here. Next slide, please, Nate, of how in the world this economic situation starts to play itself out. The map on the left depicts kind of the drought scenario from the end of the year here relative to the map on the right, which was at the end of last year. And notice that we've got a drought condition really starting to creep in. This is more going to affect the feed grain situation than it does the soy scenario as we start to get some of that dryness that's encroaching on the western United States and the western portion of our growing belt. Next slide, please. This one, I believe, is going to be, yes, the map of the United States. And this is important. I'm going to show you a corn map and a soy map. And I think those of us in the Midwest think that corn and soy are interchangeable. And to the large part, if you go through Minnesota, southern Minnesota, eastern Nebraska, Iowa, Illinois, that is the case, that we can alternate. But I think what you're going to see is once we get to the soy map is there is an opportunity for a safety valve, or almost a relief for the soy scenario that we don't necessarily have in the corn. If you pay attention to where that drought scenario was starting to encroach on the western United States, it's not in the major production areas yet, and I qualify that with a great big yet, but certainly it is moving in. Next slide, please. When we take the December S&Ds came out, this is the grain stocks report, and you can kind of see where there's winners and losers. I would consider this that the production on the west side of the Mississippi River obviously was negatively impacted. We had the derecho that rolled through Iowa. We had a very dry August. But the east side of the Mississippi River, if you notice, has largely plus signs associated with it of a change over a year-over-year concept. And this is going to be one of the things that I share is, in my best guess, we're not going to run out of corn. We might not have it in the right spot at exactly the right time, but we've got a very different scenario than what we've seen in the past. And I think that there's enough corn to get us by this year. And that's why, again, my recurring theme is, how does this play out for our decision-making metrics for next year? Next slide, please. And when you take a look at an S&D, I've given you kind of three arrows here. So I've kind of historically where we've sat as far as acres and yield and carry-out numbers. Pay attention, and I'm giving you my best guess. The USDA won't give us the 20, I should have said 21, 22. That's my error under Joe. They won't give us the 21, 22 S&D for a little bit later into the year. And so we're kind of left hanging. So if you take the acres that I gave you, which is roughly 90 million acres, you plug a pretty good yield in there. I put it 180 bushels to the acre, which would be a record yield, but it's not out of the realm of possibility. Certainly the financial incentive to the agronomic community means that we're going to pour more resources at growing a big crop. And so anything that resembles decent weather, I don't think that that's too far out of the realm. But notice once you get down to the green arrow and you compare this year to what I see as next year, is we really don't move the needle, even with record yields with the corn acres that I give you. Is notice that our carry out to use ratio is about 10%. That's going to become an important number here. The bottom line is January, the USDA was estimating that the average corn price is $4.20, and you might logically assume, well, that means next year should be $4.20. And I'd be very, very cautious, because we had a lot of corn sold coming into this year at $3.50 in order to get to that 420 average. You've got these corn right now trading around $4.50 as its start point. So I would be very, very hesitant to think in calendar year, or excuse me, crop year 21, 22, we're going to be able to duplicate that. Next slide, please. So when you take a look, this is a curve, and you might take a peek at that red dot and say, oh my goodness, we're a little overpriced. I would contend we've had an outward shift of the demand curve here recently, specifically with the Chinese interest, that would intersect that. This is a similar situation that we saw 15 years ago when ethanol was introduced. We had an outward shift of the demand curve that created a new price matrix for us. And I think that we're currently experiencing one, and that's going to hang around for a little bit. So whereas $5.50 corn that we're trading right now in the front end of the market might seem to be a little bit pricey, I'd contend that it's probably fairly priced. And if you'll notice that my carry out to use ratio of about 10%, you can see that on that x-axis there. And if you kind of move north, I would contend that new crop corn might even be technically underpriced, especially given the risk of achieving the 180 bushel yield right now. So I think the corn market is trying to tell us something with its indications. Next slide, please. When you take a look, and this is kind of reflective of what I was sharing, that even with a very similar carry out to use ratio of 2020, that 2021 probably has higher price corn for the end producer community as well as the agronomic community. Next slide, please, Nate. So we had inauguration yesterday, and I don't want to make this political, but if you are feeling a little sheepish about non-participation so far in this run-up, I'm giving you a Trump pardon at this point in time. You were kind of given a few red herrings. Next slide, please. And this is what they're going to look like as we roll forward here. Is the USDA had the biggest change ever from October to November in its stocks to use ratio carryouts here. We were led to believe that everything was just going along fine, and all of a sudden we received this huge, huge adjustment. Next slide, please. This is also reflective from a graphical standpoint of in the middle of the summer, we thought we were going to have way too much corn. A 3 billion bushel plus carryout has largely been decreased, and now you'll notice that black line we're trending below kind of the historical average. That blue line that does run underneath there is the 2013-2014 experience. I'm going to reference that once we get to the soy side of it. That was the growing season of 2014. And if you remember, we had record yields in 2014 that kind of saved our hide once we got to the fall of that year. Next slide, please. March corn has made an unprecedented run. You'll notice that one of these things is not like the others, and certainly from a pricing perspective, we are providing every incentive for the production community in order to come into this spring and plant as much as they can. And that might be our silver lining, is that statement, is we're not in the middle of a growing season where we have a drought that's causing a price response. We're in the middle of January, and we've got all kinds of time in order to adjust our habits. And I'm thinking and I'm hopeful that that is a salvation to some of our woes as we look forward from a consuming standpoint. Next slide, please. The other piece I'm going to talk about just briefly is basis. And the CME is set up as an export-based program. It's derived from the Gulf of Mexico and backs us in. And because of that, the board is doing most of the work for the corn farmer. Hit the next slide, please. This is a map of what basis is looking at through much of Iowa. And if you notice that scale on the right, you know, you're 25 or 30 under. It's very, very milquetoast at this point in time. And the board is doing the work. The basis is regulating the flow of commodities to where they're supposed to be. And we don't have any large aberrations right now in basis, nor do I anticipate that there's going to be. Next slide, please. We're not running out of cash corn. We might have it displaced slightly. When we take a look at our friends in the ethanol side of it, and this ties obviously back into the COVID scenario, you see that great big drop down in motor fuel consumption that occurred in the spring of the year. And depending on the two doctors on how we administer a COVID vaccine and how successful it is, and we get an economy rolling back again, is a huge assumption that I'm putting into some of my future numbers here. But you'll notice that we have not recovered. We're at about 90%, as Bill shared. We're doing a virtual seminar here. We're not together. Nobody traveled per se in order to come together, and that seems to be characteristic not only of motor fuel but also of ethanol. Next slide. As goes our Bob is going to go ethanol profits, and as you'll see, is we're underwater. We're losing money in the ethanol industry, not record amounts, mind you, like they occurred back in the spring of the year, but certainly not sustainable. And you might ask, well, why don't we slow it down? Well, it's a very steam-intensive industry, and if you walk outside in Des Moines, Iowa today, you would probably see some freezing that's going to occur. And so we can't shut these facilities down in the colder months. I strongly suspect that if this continues on into the spring of the year, once we do reach the warmer weather, that we will start to slow down ethanol production. Next couple slides, please, Nate. We'll show you what production looks like as well as the stocks. We have stocks that are starting to get just a little bit choky right now. Next slide, please. And resulting is some DDG pricing that also is starting to get just a little stemmy. Just for what it's worth, certainly DDGs are kind of a double-edged sword. They take corn that could go into a different use, i.e. feed demand, but do provide us a protein substitute, and that's going to be important this year. I was just taking a look at some formulas earlier today about the utilization of DDGs, and they still work even at this lofty price, even at this $200 plus. They still work into the rations because of our amino acid availability. Give us another click, please. When we take a look at China, certainly you take a look at those bars, that black line is corn, and China has suddenly shown up with an appetite for corn. I would contend that the phase one agreement was going to occur as far as purchases with or without an actual agreement simply because of China's demand. You'll notice over on the left-hand side of the chart back in 2015, if those of you perhaps from the southwestern portion of the United States, is when we took milo or grain sorghum, and we were exporting the living daylights. It was trading at a premium to corn at that point in time. It was claimed because it was non-GMO, and that's why it was going over to China. Certainly that has shifted, and the predominant exports are now, or imports into China are of corn. And I think there's a little bit of a hint there, a little bit of a whisper in the market. Next slide, please. When we take a look at the fund community is record long, is through some monetary policy as well as some visions for inflation is the fund community has come alive into our agriculture markets, not so much into our livestock markets, but more into our grain markets. Started with wheat, transitioned into soy, recently has been corn, but from an amalgamated position of those three commodities, we've never been here before as far as fund length is concerned. That's a large part of our driving force behind the price appreciation. Next slide, please. Beans also taking off and rolling and marching to their own drum. We've never been here before either. Next slide. And when we take a look, this is the interesting one to me, is the La Nina that's encompassing South America production has largely been more hype than it's been deliverable. These are the numbers coming out of the January report. More recently, we've had some rains across Argentina. We're starting to shrug just a little bit. And it might make you say, what's the big story here? Is that we've got, 130 plus million metric tons coming out of Brazil. Their previous record high was 124 or in change. What's the story here? And it's all about timing. It's the United States has played a larger role in the exports of beans to China. Our exports out of the United States are roughly double what they were at this point in time last year. Our exports to China are up 270%. And so it's a displacement of the crop. The South American crop appears as if it's on cue for a relatively decent, if not record, production, and yet we're still rallying in the face of that. It's all about timing. Next slide, please. It's our ending stocks forecast for soy, very, very similar to what we saw in corn. Is we thought we were going to have gracious plenty, and then over the subsequent reports is we are now down to levels that replicate 2013, 2014, which is our baseline year for I am out, is what that one says to you. But again, very, very different. Unlike that year, we started this whole scenario much later into the year, and this year we're going to at least provide the economic stimulus before the planting season. Next slide, please. Tale of where the soybean sit is different than where the corn is. The east-west bias is still intact, mind you, but you'll notice that that only dark blue state on there is Illinois. Illinois is hogging all the beans this year. That if you take a state-by-state comparison, and Josh Sonneman in our office recently did this, the state of Iowa is basically going to break even. If you take a look at crush from December 1st when the stocks report came to September 1st when we officially get our new crop, and combine that with exports, it comes out almost exactly 407 million bushels, and you'll notice the state of Iowa has 407 million bushels. So that means we're going to have a displacement. We are going to have some discomfort in the soy complex, unlike what I think the corn is from a physical supply standpoint. Price not being a component herein, mind you. It's about the physical availability of product. And if you're on the west side of the Mississippi River, I would highly encourage you to think ahead and about what you're going to do, whether that's the forward purchase of soybean meal, which is almost impossible at this point in time, holding on to some soybeans that you're going to have as a bartering chip with the processor of once we get into those summer months, and perhaps they start to reduce crush because of lack of availability. We are going to have to get creative, guys, as a pork production community in the summer as far as our protein the constituent inside the diet. I don't think DDGs are going to be our savior because of the ethanol grind probably starting to back off a little bit unless a COVID vaccine allows us to get an economy rolling again, which allows motor fuel use to bump up and DDGs become more of a residual. I just think we're in for a very, very interesting summer. Next slide, please. So unlike what I was sharing with you with the corn, notice how the soybeans will follow the Mississippi River. And anybody that's driven or flown over this area, there's some pretty good production areas right down the Mississippi there. We're going to probably steal some acres from other crops, notably cotton. The timing is going to be the most important part. And if you take a look at perhaps midway through Kansas, through Missouri and southern Illinois, you've got about a $2 cash incentive right now if you're a farmer in south of that area to plant an early season variety beans and deliver it against the September contract perhaps. And so we've got we're going to be displaced, especially late in the summer. But trucks have wheels for a purpose, and that's in order to move product to where it needs to be. So I think this might be our safety valve as we take a look in the forward into the future. So August isn't quite as tight as what you might otherwise surmise. Next slide, please. I might have a little slow internet connection here. I don't see it. Next slide, please, Nate.
Yeah, you're on the
There we
supply
go.
and demand table. Yep.
There we go. Yeah, yes, indeed. And I've given you a couple of arrows over here also of where to pay attention. And again, I goofed on the 21, 22 on this slide also. But this is my best look at going forward. And I've done the exact same thing. I've allocated the acres over to the soy complex. I've given you a record yield that would be equivalent to 2016, 2017. And notice that red arrow bottom line. We just don't seem to fight ourselves out of a wet paper bag at this point in time. A 4% carryout to use ratio, even with pretty good yields and an increase in acreage, doesn't buy our way out of the woods. And this is going to be a kind of the crux of the market of who wants the acres the most and how many resources are we willing to throw at the crop, which we've got enough financial incentive. And then perhaps most importantly, of what kind of growing season do we get in the 2021-22 season. Next slide, please. So I gave you my reference to 13-14 as being our analog year of I've run out. And all I've done with this one, my 21-22 estimate, is just reduce my component there, 2 bushels of the acre. You'll notice on the previous slide, I had a 52 bushel to the acre yield. And if we just reduce that to 50 bushels, just arbitrarily, and follow the math down, you'll notice that we end up with a less than 1% carry out to use ratio there on that bottom line. And guys, that is unsustainable. And so this is the tension in the market. Next slide, please. I'll show you what that looks like on a scatter. Is once you get over there, that red dot in the upper left-hand side, technically we're approaching an asymptote where price discovery is who knows. Is how does that go? It becomes an inelastic curve at that point in time once you get down. We've never been here before. Again, second only to that 13-14 carry out. Add a little inflation, add a little bit of Chinese interest coming back to increase the demand component, and we are off to the races. So I think what I'm sharing here at this point is that these prices, although elevated, are also justified given the scatter. Next slide, please. When you take a look at China, you can hit the next one there. The black line represents what their monthly purchases have been. The black line, once you amalgamate all this together, is China will have record purchases in 2020 once we close the books there at roughly 100 million metric tons. The United States taking a larger percentage than we have in the past few years away from the South Americans, and hence the tightness that we have in our balance sheet. Next slide, please. This is indicating that I think we would have done the phase 1 with, or kind of hit those commitments with or without an agreement. China needs commodities, and I think that's going to become evident here as we roll forward for the next couple of years. Next slide, please. The question is it going to be our pork, or is it going to be our soybean? Crush in the United States has been running at a record, and even though I would tell you that we need to mitigate our utilization of soybeans, we are plain not doing it whatsoever here. Next slide. We're going to go through this pork side of it, and Nate, if you want to hit one more. We've got a few red herrings also. I think we identified a few that are occurring in the grain market. This is our most recent quarterly hogs and pigs report, and I've put a circle around my areas of concern, and that's those heavier weight animals, but you'll notice that behind those are fewer lighter weight animals, and so I think we're right in the cusp of a huge transition on the pork side of it because of this. We still have a little bit of carryover from the unknown. And hit the next slide if you would. This is the December report that you've got first. The next one is the September report. I'm kind of going backwards here. And if we go to the June report, you can't fault the government in the midst of a COVID environment and a lot of the activities that took place of having a difficult time to get a grasp of what was going on with the quarterly hogs and pigs report. And if you remember correctly, when we take a look at these numbers, and again, I've highlighted them in a box, it's your 106 and 110%. And if those numbers were to have occurred in the September report, that would have impacted our late December timeframe. And unfortunately, this year we had Christmas and New Year's falling on a Friday. That's a worst case scenario for the pig industry. Is we didn't realize this. The USDA was off, and again, I think I give them a pretty fair play. I am leaning that the December numbers are closer to accurate, and so therefore that those lesser animals laying behind is what I'm kind of basing a few assumptions on, as well as some production interruptions. Go ahead, next slide, please, Nate. That we've had largely across the west side of the Mississippi River. The teal colored line is at what we would have slaughtered if the September hogs and pigs report were right, and that would have caused us great difficulty. Next slide, please. Fortunately, we didn't bump up against that. Packing utilization has impressed me. We're using an internal number of 5% slack from optimum, and it appears that the packing community is doing an even better job. We're running a lot of Saturdays to make up, mind you, in order to get there. Go ahead, next slide, please. But when we continue to run these 2.7 million head kills, I don't think we can be surprised that we're putting a little bit of a thumb on the producer's share of the revenue. The cutout has been very erratic based on many factors. Seems to be settling in here to the 75-cent or so range right now. Next slide, please. The producer's share of that has largely been compressed. Been a tough year. In 2020 was a tough year. The beginning of 2021 is also very difficult for the pork production community on the revenue side. Simply, we're supplying more animals than we have shackle spaces, and we're feeling that pinch. Next slide, please. So let's take a look at China. The recurring theme in the grain market is also going to be a recurring theme in our hog market. Chinese pork production is at a 16-year low. Certainly trying to rebuild. Next slide, please. And we've all seen kind of pictures on the internet of what this looks like. This came from Pork Magazine of 85,000 sows on one site. Next slide, please. The Chinese government largely perpetuating that yep, everything looks good over here, and I find that the numbers don't quite match off with this sentiment here. That would have certainly appeared that they've got expansion. I don't think anybody is arguing that, but their need for more pork, I think, is going to be evident. You had a report out today that they released more from the strategic reserve, as well as have some new cases of ASF that have popped up in China. And this is what I'm showing you. The headlines are the great big noisy gongs. Listen to the whispers. What are the prices telling you? What are the behaviors looking at? Next slide, please. Fair to finish operations at the end of the year, we're break even at best. Notice in that box, Dr. Meyer puts these together for us, is that 2021 average cost of production for probably the top 25% is going to be above 70 cents. And this is after we've been in the low 60s for several years in a row. This is a complete function of grain prices going higher. And even though commodity prices or the revenue side of it has moved up, it's largely been mitigated by our increase in input prices. Next slide, please. All right. Dr. Meyer put these together after the December hogs and pigs report. That circle at the bottom indicates that our production looks to be up 1.5% year over year. Not enough to drown us out, so that's a good sign. Next slide, please. And when we take a look at prices of where those sit, kind of again at this light, very light profit levels, given our cost of inputs, so a few discrepancies as far as the baseline numbers of where opportunities might lie out there. Those are, you'll notice that third quarter that the futures are trading at a bit of a premium relative to where we anticipate that the cash numbers will play. Next slide, please. All right. June hogs, you'll kind of find that just unlike the grain side of it that has been making new highs, June hogs are just kind of caught in this quagmire, kind of right in the middle of that range. You almost got to search it out to find where that black line is. And I am optimistic that once we get a little bit later into the year, that will also have a bit of a breakout for a myriad of reasons. Next slide, please.